A warm welcome to the Risk Reversal Podcast. Guy Adami today joined by Peter Boockvar, the CIO of OnePoint BFG Wealth Partners. That name will be changed, so it'll be easier for me to say. But for now, it is what it is. And Peter, it's always a joy to have you.
Thanks, Guy. Appreciate being on with you.
Now, listen, your work speaks for itself. We've said it many times, and seemingly each week something new happens. We obviously have Jackson Hole, Wyoming, that Fed Gala, which typically is interesting, I think more so this year, given some of the rhetoric and the vitriol around the Fed. So let's start there. I'm not expecting anything to happen in terms of policy. I don't think you are either, but some of the commentary and then the subsequent backlash it might create could be market moving.
It could. Well, what's interesting about this confab is historically it was just a real boring gathering of PhD economists and then some others. But then when Ben Bernanke sort of used it coming out of the great financial crisis to literally express what policy was going to be, that's what made this whole event more of a market moving possibility. I do think because of the lack of visibility for any of us past sort of the next month, I think Jay Powell's experiencing that same thing. And all I see is him sort of confirming our market expectations for a September cut, but I don't see how he pre-commits to anything past that. Now, will he cut in the meetings thereafter? Yeah, maybe, but why would you put yourself out there before that with still so much information to absorb, and not just random information, really important information, particularly if we're at an inflection point in the labor market and all eyes are on the price pass through with regards to tariffs. So, and I think it's just prudent. Say what you're going to do in September and say, we're just going to wait to see what happens thereafter.
The tariff inputs or the tariff impact, let's talk about that for a second. Say what you want, that core CPI number that I saw was hot. Now, people explain it away. That's fine. That's what people want to do. PPI, difficult to sort of explain away. And that's, again, without the impact of tariffs. But you've spoken anecdotally to a lot of people trying to get ahead of this. There's an inevitability to what these tariffs are going to do to inflation, I think. Now, the optimists will say it's going to be a one-off. The market will sort of figure it out. The pessimists will say this is going to be sort of the next leg higher as inflation starts to basically get back off the mat and reaccelerate to the upside. I find myself sort of in that camp, which really makes it difficult for the Fed to be anything but hawkish going forward.
I agree. I think for at least a period of time. I mean, theoretically, yes, tariffs are one-time in nature in terms of the tax that it is. However, I think that's sort of a superficial viewpoint of it. I think that if tariffs really shift around supply chains in a notable way, it can lead to a multi-year path of higher prices. And just a couple of examples, and one that I just literally read in the weekend Wall Street Journal. So there's this guy who imports used cars from Canada. And for a couple of years leading into November last year, right, into the presidential election here, he was importing about 1,000 used cars from Canada to the US, and then he was flipping it here, and whether to flipping it to mostly to dealers. That ramped up right after Trump won in anticipation of tariffs through January up to into February, 1,400 cars. Now, because the 25% tariff, and these aren't protected by USMCA, 25% tariff on these Canadian imports, he's only importing now 400 used cars. So here is the potential for a multi-year shortage of used car imports from overseas. And keep in mind, with new car sales in the US still running at an annualized rate below the 2019 level, which implies less used car supply also in the US, that you can have a multi-year rise in used car prices. The other big example, and this is probably the biggest because it's the biggest component of CPI, is rents and the pace of multifamily construction. Now you may say, okay, well, what do tariffs have to do with that? But you have two things. Number one, you still have an elevated cost of capital, which has really altered the financial calculations of building an apartment building right now. And then the cost of materials. I mean, steel is a major input to building multifamily apartment building and lumber and aluminum and copper and a variety of other things, in addition to labor, specifically construction labor, where we use a lot of immigrants for that labor. So we're seeing, particularly in the Sun Belt states that have experienced the most amount of supply these last couple of years, we're seeing a very notable, when I say notable, I'm talking about 60 to 70% declines in new multifamily construction in a lot of Sun Belt states. So we're basically sowing the seeds for a multi-year increase in rental inflation after this current deceleration runs its course. That's how I think people need to be thinking about these tariffs, not the superficial, it's a tax, it's one time, boom, 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 we're done. We are mucking up global supply chains. And in addition to changing the calculations, as I mentioned, with higher interest rates, and this could lead to a multi-year period of still elevated inflation, which means we're still going to have a period of elevated interest rates, even if it's not necessarily on the short end, it could be on the long end.
Yeah, and that reinforces one of the points you made earlier this year. And again, typically in our world, if you're early, you're wrong. But for you, it's typically you're early and right. And what you have been saying and what you said was you watch and see, based on everything that's going on, the economic data is going to be lumpy as hell. And it has been, without question. It's hard to make heads or tails of a lot of things we're seeing. But to your point, people will talk enthusiastically about it being a one-time thing, these tariffs and the impact, but they're looking past how it disrupts the entire business cycle and, import, exports, and all those things. Those don't turn on a dime. And what you've just described is, yes, anecdotal in nature, but it can be made across probably a swath of different industries. And obviously, the home builder section is extraordinarily important. I think that's one of the leading indicators for what's going on, but autos as well. And then just sort of run the gamut through in terms of what it's going to be in terms of food costs and other things. So the inflation genie, I don't think has been put back in the bottle. And then to my question, it was this time last year, I think the S&P was 5,500-ish. Don't at me if I'm off, but I'm pretty close. Obviously, we're 6,400 now. At that time, there was enthusiasm. It appeared as though then candidate Trump was in the catbird seat. The market obviously liked that. There was also enthusiasm around 6 potential rate cuts for 2025, the year we find ourselves in now. Obviously, I think we all can agree that we're not going to get 6, but this enthusiasm with the S&P almost 900 points higher of 2, maybe 3, people can be enthusiastic, but what I've said, we're more than priced that in terms of the price appreciation that we've already seen. Thoughts?
No question. There's rarely sort of any context around which a rate cut comes. People don't think about, okay, what was priced in, as you mentioned, coming into the year and what have we gotten? It's okay, the Fed is going to cut, and it's this just knee-jerk reaction, okay, you got to buy stocks. Now, there's no question that the AI tech trade getting a second wind after the smacking it took after the DeepSeek news certainly is a big driver here as well. But I definitely attribute the sort of catch-up that we've seen over the past couple of weeks in small mid-cap stocks in response to this rate cut. And people say, well, if it's really higher interest rates that have most hurt small and medium-sized businesses, particularly those that borrow floating rate, well, the Fed's going to save the day here and help these companies, let's buy them. But you're right. We were expecting a year ago today about a 275-ish, 285-ish Fed funds rate. And here we are at an effective rate of 4.33 going into most likely 50 basis points by year end. A far cry. And also the long end of the yield curve where rates, and I know you've talked about it a lot, that remains very elevated. And in fact, what's interesting, we keep talking about the global rise in interest rates. Today, the 30-year gilt yield in the UK closed at its highest level since 1998. And that comes a week after the Bank of England cut interest rates.
Well, I was just going to say, for all you rate cut enthusiasts out there that think magically if a central bank or if our Federal Reserve were to cut interest rates, it has an impact on the rates that you're basically concerned about. Look what's happening right before your eyes. And President Trump will talk about the rest of the world is lowering their rate. He's correct. They have been, but it has done nothing to the rates that matter. And as we're sitting here, you just mentioned that, but Spain, Italy, Japan, Germany, very important what we're seeing there. And people say, well, why you focus on those things, Guy? It's United States. We dictate everything. Yes and no, because there is a dependency there. When you own your own debt, it's fine what the rest of the world is doing. When the rest of the world owns your debt predominantly, you have to pay attention. So thoughts on that?
Yeah, particularly the Japanese, which we know is the largest foreign holder of U.S. Treasuries at about $1 trillion. And just as we saw a global suppression of interest rates over that 15-year time frame, we're now seeing a global rise in long-term interest rates. And investors are very smart around the world. They see how bonds trade from a relative performance basis in Europe and Japan and Australia, South Korea and the US. And there's a very high correlation amongst these bond markets. And, the markets are sending us a message here that central bankers, particularly in Japan, in the US, in Europe, other parts of Asia, they are losing control is a little bit strong, but they are becoming much less able to impact long-term interest rates. And that, yes, they have this firm grip in the overnight rate, but past that, and particularly in the US, that is most sensitive to the 10-year with respect to driving mortgage rates, and even and other types of commercial real estate that's priced up the 10-year, and even a lot of bank loans in the US are also priced off the 5-year. So the 5-year, on one hand, can be pulled in one direction by what the Fed funds rate does, but if long-term interest rates go up, that can sort of mitigate any drops in the 5-year. That can keep the 5-year elevated rather relative to the overnight rate. In other words, the belief that lower short-term interest rates are going to be this panacea for economic activity and sort of relieving the interest expense burden on so many companies and individuals, it just may not happen.
We saw it was basically this time last year, which is the first week of August, where our U.S. equity market faced something it had not faced in quite some time, especially vis-a-vis the VIX, which I think at one point the first week traded north of 60. Obviously, we hadn't probably seen anything like that since maybe COVID, but certainly the great financial crisis. And it was based upon a couple different things. In July, we saw a pretty tame CPI number here in the United States. Dollar yen, I think, was north of 160 early that morning. It proceeded to trade down to 157, which set the tone for a precipitous drop in the dollar against the yen. That whole yen carry trade began to unwind, and it manifested itself in volatility in our equity market. Since then, not a lot has changed on the bond front in Japan. As a matter of fact, I could submit that things have probably gotten worse. Dollar yen has been tame. It's been in a bit of a range. Sitting around as a layperson, what should I be watching in terms of dollar yen? A strong move to the downside in the dollar, in other words, going from, I think it's 147 now, down to 138, or strong move to the upside in the dollar versus the yen from 147 maybe up to 160. What should be the warning sign?
I'm looking for downside, or in other words, strength in the yen, because after the upper house election in Japan, where the Prime Minister Shiba lost his governing coalition, or majority, I should say, or both, after losing the lower house at the end of last year, the pushback from the Japanese citizenry was, we are pissed off about higher inflation. And this is how they voted. And I thought the Bank of Japan would immediately take heed from that and lay the groundwork for some more rate hikes by the end of the year. When they met soon after, Ueda was still wishy-washy, but still laying out the possibility that they would hike. Then all of a sudden, our Treasury Secretary, Scott Bessent, calls out the Japanese to start to resume raising interest rates. So to me, the press from the BOJ is extraordinary. And I don't think people are thinking about what the BOJ is going to do here in the US. I think the only thing on the minds of the US investor is where does the AI trade go with NVIDIA and others? And what's the Fed going to do? I don't think there's any connecting of the dots that the BOJ could actually, by year end, give us 2 rate hikes, which would then also have global reverberations around bond markets that can completely swamp what the Fed is trying to do here.
I agree with that, and that's obviously something I'm on the lookout for. Their citizenry is pissed off, rightly so, because they have an inflation problem. By the way, they were able to curtail for decades, but that genie is clearly out of the bottle. They have rising yields. I think JGBs are the highest, and you know this better than I, but I think 14-year highs. I think their 30 and 40-year yields are at all-time highs, yet they have a currency that really can't get out of its own way. So they're up against it, and their people are upset. And again, something's got to give. So if you were to see continued move higher in yields there, which I do think you will see, and then the knee-jerk reaction, which would make sense for their currency to actually strengthen on the back of that. In other words, dollar yen go from 147 maybe down to, a lot of people think 130. That's not going to be good for risk assets in the world, specifically our equity market.
I agree, because certainly if it leads to a U.S. 10-year yield that goes north of 4.5 and maybe even approaches 5. Now, what's left of the Japanese carry trade or the yen carry trade, I don't know. It's so hard to quantify. So it's hard to know from that impact. To me, the real impact would be this resumption higher of this global rise in interest rates. And you had mentioned European yields. I mean, just a few days ago, French and German bonds, 30-year bonds, closed at 14-year highs.
Yep.
So there is something going on here when it comes to investor appetite for duration. It is being ignored for now until it's not.
Does the fact that the Nikkei it's seemingly like many indices around the world, I mean, that's seemingly impervious to what we're talking about? Maybe it should be, because in terms of their markets, it's party on.
Yeah, it's interesting. I mean, and full disclosure, we're long some Japanese stocks, so I'm enjoying it. And it's interesting to think about. Well, it used to be a time when you would buy Japanese stocks when the yen would weaken, because many of these big companies that dominate the topics in the Nikkei are big exporters. But what we've seen over the past couple of decades in the Japanese economy is, because they've located and created a manufacturing presence all around the world, they're less sensitive to yen weakness. I mean, look at the Japanese auto industry that builds a lot of cars in the US. They don't necessarily care where the dollar yen goes. And also, you have a market that obviously is underperformed for decades, and that created a very cheap market. A country that has really focused over the last couple of years on corporate governance, stock buybacks. I mean, the Tokyo Stock Exchange went out and shamed companies whose stocks were trading below book value. So there's a huge culture change in terms of the equity markets there that I think has been able to overcome this rise in interest rates. And actually, from a capital allocation standpoint, maybe it's actually benefited, because people are saying, you know what, I think maybe having my money in this inflationary environment is safer in Japanese equities, more so than JGB yields, which are still well below the rate of inflation, which is still running north of 3% in Japan.
Yep, yep. If you think about it that way, and that's why I asked, because I knew you'd have an answer, it all starts to make sense. So all those concerns sort of back burner for now. This week we're going to hear from retailers, and it's going to be fascinating to me to hear what they say on, are we able to pass through our elevated cost? Do we even want to? And then subsequently incur the wrath of the administration. What are you looking for, not in terms of the numbers, just in terms of some of the rhetoric around it?
Yeah, so it's going to be a couple of things, and I have a feeling we're going to hear the word elasticity a lot. Basically, these retailers defining the ability for them to push price in certain product lines and others where they cannot, and they have to absorb any margin hit. I mean, when you look at the companies that are reporting, even Home Depot and China and Walmart and Target, that are still very reliant on imports from China, on how they're able to absorb this. And it's all going to be around the profit margin line. I mean, we all know the algos are going to first look at top line and bottom line relative to expectations. But I think the more sophisticated investor should be looking at, okay, what's the direction of their profit margin? What sort of impact do these tariffs have on that line item? The less of an impact would imply that the consumer is probably eating those tariffs. The more of an impact means that these companies don't feel like they have the ability to pass it on to us, and they're going to have to absorb it themselves.
We're going to find out who's well suited, who's not, who has an inventory problem, who's not. But that's individual stock stuff. The bigger tell is, what is actually going on, and are these things starting to manifest themselves? Because I will tell you, just me, as I started at the top of the show, and as you sort of reinforced, the whole tariff thing is not. It's not been felt in the numbers that have been heating up. So I think we're going to learn a lot in this backward looking and then forward listening retail environment. The importance of the AI trade, you said it yourself. I was going to bring it up, but you mentioned it. We're going to hear from NVIDIA, I think, next week. There was some reports out. I saw some studies talking about the ROI on the back of AI might not be all that it's cracked up to be. I know firsthand, reading some of these reports, that Facebook obviously is levering AI in a major way in terms of the margins. Walmart is as well. Those are the two that come to mind. But the report sort of stated that, maybe it's not all that it's cracked up to be. Maybe on a productivity front, yes, but maybe not on the bottom line front. So thoughts about the importance of what you're going to hear from NVIDIA. The quarter's going to be fine. It comes down to the magnitude of the guide higher, which the last few quarters, the numbers are bigger, but the magnitude of the guides have been smaller.
Yeah, and it seems like that's been the case for the last couple of quarters. I mean, what'll be most interesting with NVIDIA is particularly their China business. I mean, look at Applied Materials last week. That stock got slammed because of a lot of uncertainty with their ability to sell into China, not just in terms of all one thing, the demand, but also the license process that they need to go through. On the spend for NVIDIA chips, I'm sure it's still going to be robust, but you make a great point on some of these questions on the extent at which Gen AI is going to change our lives. McKinsey particularly had a report that just came out within the last couple of days, and they really talked about this, and where it's going to be very helpful as a tool to help our productivity and efficiency, both from a business standpoint and also a household standpoint. But maybe it's just an enhancement rather than this life-changing thing. And what was really interesting, actually, which I thought is, when we all are debating what is the labor market impact going to be from AI, and how many jobs are going to be lost, and so on. And one of the particular areas that there's been a lot of fear that Gen AI is going to wipe out all these jobs was in help centers. You call somebody and you hit a button and you end up speaking to an agentic AI bot. Well, it turns out that companies are actually realizing that people that call a help desk want to talk to another person. So the way that they're integrating Gen AI is to actually empower that operator to better answer your questions. So it's not replacing that job, it's enhancing that job. And then that begs the question, okay, this is great, but what are we going to spend $300 billion a year to basically create an enhanced Google search? Is that what this was all for? Yeah, it's great. It helps our productivity, but is this the life-changing thing that you would think is the case with all the money that's being spent? Because we know, God, one of these quarters, some of these spenders are going to say, you know what? We're going to take a pause.
Yeah.
We're going to rein in some spend. And when that
100%.
comes, NVIDIA, we know, is on the other end of that conversation.
No, listen, without question, I understand the Facebooks and to a certain extent Googles and a lot of these companies, Amazon, they're going to have to say it because they'll say that this is a generational type of thing that we can't fall behind on. But for some companies, if they start to see margin compression, they're going to look at those cost lines and say, we can cut this out very easily. And that's going to be one of the first line items that go. And I use this term, and I'm sure you think about it. People believe there's this spend is written in stone, like in Sanskrit, written in tablet, like the 10 Commandments. But I'm concerned about the sanctity of this CapEx, because when things start to turn, that's not going to be as solidified and as cemented, I think, as the market believes.
I agree. And I also think what many investors are not fully thinking through either. It's interesting is that here we stand today with this whole trade sort of back on, and it amazes me that people sort of forgotten about DeepSeek and the impact that had. Well, since DeepSeek, we've had many more Gen AI models come out of China. And what that means is, one of the unique things about and the dominance of US tech was they dominated the world in terms of their business. Now, outside of China, which didn't allow Google search and doesn't allow Facebook and Instagram and so on, these companies dominated the world. What's going to happen now is now that China is a major competitive threat in all these models, where if you're a startup in Singapore that's bootstrapping it and you're deciding ChatGPT or the Alibaba model, well, Alibaba is selling it at half the price as ChatGPT. And you know what? They're pretty comparable in terms of their capabilities. Well, I don't have much money in the bank. I'm just going to get the Chinese version. This is the first major tech sort of product that we have major global competition. And I think that is not something that we appreciate. There's just this belief that US companies are doing this, we're going to dominate, and we're going to have all the market share around the world, and all the spend is going to substantiate itself. But I think we can't sell short the Chinese competition, not necessarily us against them, but if you're a business outside, like I gave the example of Singapore, if you're a business in Europe or in Vietnam, and you need to decide how to spend your money for one of these products, you may pick a Chinese company instead of the US one.
Well, we're going to find out in the weeks to come. We're going to hear from NVIDIA. I look forward to that. I always look forward to speaking with you. Peter Boockvar, the CIO at OnePoint BFG Wealth Partners. Where can people find your work, Peter?
So on the wealth management side, they can go to OnePoint BFG and check out our website and learn more about us. On the daily market and economic commentary that I write every day, they can go to Substack, type in my name, and I title it The Book Report.
As well you should. It's required reading in our world. Hopefully folks have come to the same conclusion in their world as well. Thank you, Peter, so much.
Thanks, Guy.